Today, I want to look at the market through the eyes of three people you definitely know: Elon Musk, Michael Burry, and Tom Lee. They're all looking at the same future, but they're not seeing the same winners. Let's start with Elon Musk. Recently, Musk sat down for a long-form interview on an investing podcast hosted by Nikhil Kamath. In that conversation, he said again that he doesn't really run a stock portfolio. His focus, in his words, is building companies, not trading other people's stocks. But when the host pushed him on where the future value will come from, Musk was very clear. He said that over the coming years, most of the world's economic value is going to be created in just a few areas: artificial intelligence, robotics, and, over a longer horizon, spaceflight. He pointed to Alphabet, Google's parent company, as a firm that's already built a strong infrastructure to monetize AI. And he described NVIDIA as an obvious beneficiary of the AI boom. The message was simple. If he had to pick outside his own companies, he'd look at businesses that are deeply tied to AI and robots. Musk also talked about what that might mean for everyday life. He floated the idea that within the next decade or two, we could move toward a world where people don't have to work just to survive, and where work becomes more of a choice or a hobby for many people because AI and robots are doing more of the heavy lifting. So in Musk's framework, the big winners of the future are clustered around three themes: AI, robotics, and space. Now, let's flip the lens and talk about Michael Burry. Burry, the investor made famous by The Big Short, recently launched a new Substack newsletter called Cassandra Unchained. In one of his early posts, he went after Tesla in a very direct way. He argued that Tesla's market capitalization has been ridiculously overvalued for a long time, and that he still sees it that way today. One of his main concerns is how much the company relies on stock-based compensation. According to Burry's calculations, Tesla's stock-based pay dilutes existing shareholders by roughly 3.6% every year. In his view, that's a meaningful hit to ownership, and importantly, he points out that Tesla is not buying back stock in a way that would offset that dilution. On top of that, Burry has raised red flags about Elon Musk's massive compensation plan, which could grant Musk a very large amount of additional stock over time and further dilute other shareholders if performance targets are met. He doesn't stop with Tesla. In that same letter and in related comments, Burry criticizes a wider group of tech and AI names, including some of the most popular AI plays, arguing that companies are understating the real cost of stock-based pay and that valuations across parts of the tech sector have become excessive. He also takes aim at the story around Tesla itself. He notes that for years, the narrative has kept shifting. First, it was all about electric vehicles. Then the focus moved to full self-driving, and more recently, the hype has turned toward humanoid robots. To Burry, that constant narrative shift is a warning sign, not a comfort. So if Elon is leaning into the AI and robotics future, Burry is effectively saying, be careful, a lot of this might already be priced beyond what the numbers justify. Finally, let's bring in Tom Lee. Tom Lee is the co-founder and head of research at Fundstrat, and he has a reputation on Wall Street as a persistent bull, especially on U.S. equities and Bitcoin. In a recent CNBC interview, Lee said he believes Bitcoin could reach a new all-time high by late January. Even though the start of December was choppy, he still described both December and January as promising months for risk assets. On the equity side, he's laid out a very aggressive target for the S&P 500. Lee has argued that the index could climb to the 7,200 to 7,300 range, which implies notable upside from current levels. In other interviews, he's talked about the possibility of roughly a double-digit rally in a relatively short window if conditions line up. What are those conditions? For Lee, the key variable is the Federal Reserve. His view is that when investors fear a very hawkish Fed, higher for longer, more tightening, it weighs on both AI stocks and crypto because it pushes up the discount rate used in valuation models. But he argues that if the Fed starts to lean more dovish or even just less aggressively hawkish, that shift could act as a powerful tailwind for both tech and digital assets. He's also pointed out that the bond market already looks more dovish than the Fed's own projections, which, in his opinion, gives the Fed room to ease policy if inflation keeps trending lower. In some of his comments, Lee has suggested that if the Fed does begin cutting rates in the coming months, you could see a strong move higher in AI-related stocks and in major cryptocurrencies like Bitcoin and Ethereum over a 3-month period. So, putting it all together, Elon Musk is focused on a future where AI and robots and space companies capture a huge share of global value, and he name-checks firms like Alphabet and Nvidia as obvious beneficiaries of that trend. Burry is warning that parts of this story, especially around Tesla and some AI plays, may already be priced far beyond what the fundamentals support, with stock-based compensation and dilution eating into shareholder value. Tom Lee is sitting somewhere in between on tone, but firmly bullish on direction, arguing that if the Fed becomes even slightly more supportive, both stocks and crypto could still have a significant leg higher from here, with Bitcoin potentially hitting new highs by late January and the S&P 500 reaching into the low 7,000s. The market doesn't have to pick just one of these perspectives right now, but as investors, we do have to decide which of these stories we want our portfolios to line up with. The Musk version of an AI and robot future, Burry's caution around valuation and dilution, or Tom Lee's bet that a softer Fed will keep the party going a little longer.